Today's episode is brought to you by Kaya NXT. Later in the show, you'll hear more about how you can take the next step for your clients with Kaya NXT's alternatives education courses. But for now, let's get into today's interview. Today, we've got a very special interview. I am joined by Satish Mansukhani, Managing Director of Investment Strategy at Rithm Capital. Satish, welcome to Monetary Matters.
Thank you, Jack. It's a pleasure to be on the show with you.
So, Satish, Rithm Capital is a mortgage real estate investment trust. It's a diverse asset manager as well. Over 80 billion of total investable assets, roughly half of that balance sheet, half of that assets under management. We're going to get into that in a second. But Satish, I first want to ask you, you had a post on LinkedIn that was really interesting. You've been talking about this difference between control and visibility, because as we know, there's been some high profile bankruptcies in the credit markets. Particularly, I've got two in mind, and a lot of folks say, oh, we have visibility into this, but why are you focusing on the impact on control? What's your point here?
So just to take a step back and weave the response to that story in the context of the owner-operator model at Rhythm, is very much a part of our DNA of owning the assets, controlling the assets from origination through the life cycle of servicing, and if they require special servicing, to the final delivery of results, which is for investors, is the end returns and the performance of the assets. That is the DNA of the firm. It is how we distinguish ourselves relative to a lot of others where I see that there are partnerships that are formed. And through those partnerships and alliances, you certainly can get some visibility. However, there are limitations of that in terms of even how much visibility you can get. So, for instance, I'll give you an example. If we service a mortgage loan, we are able to go ahead and attach a lot of other accretive data points and data trends to give us better information and predictive power on the performance of those loans. If you're only starting out now with the alliances, you might get the same data, but you don't have, by visibility, the entire history to go ahead and contextualize that performance. Is it good or bad, or which variables are going ahead and are powerful predictors of performance. So I definitely feel that when we're having conversations with our investors, it's educating them about that. I think the situation, the cases that you mentioned clearly are show the lack of control. They might have had access, but they clearly didn't. Like, that layers of control eroded very quickly in the waterfall in terms of how deep you actually can go through and exercise those controls. So I feel that especially in areas that we are focused on, it is control means direct authority over the assets. In the case of a mortgage, it's verified liens. It is monitoring trust accounts. It is third-party custodians who are reconciling cash flows on a daily basis. It's seeing how the assets are performing, usually through borrower reports, and it's triangulating that with public data, private data, and so this is how the mortgage DNA of this firm in managing almost 800 plus 850 billion of MSRs, a book of 4 million consumers, and it is a value proposition that we bring to our private funds vehicles as well.
So you have a huge mortgage servicing portfolio, as you said, over 800 billion in unpaid balances. So you have a lot of visibility as well as control into that mortgage market. How are you seeing the overall shelter world? And I guess let's start with mortgages. I and other macro observers who are not insiders like Rithm Capital, but there's a lot of publicly available data from the Federal Reserve, for example, on mortgage delinquencies, and they appear rather low, maybe slightly higher than 2021 or 2022 when it was very, very low, but extremely low compared to history. Once you zoom in and have the level of extreme granularity that you and Rithm have, What else are you seeing beyond that?
I would say at a very high level, the cycle that the pandemic era induced was one of stimulus, excess cash and deposits that consumers benefited from, households benefited from that. And that led to credit scores increasing because there was a lot of excess cash. Consumers could go ahead and, if they were prudent in managing their finances, could pay down their debt and could ease up any credit capacity utilization if they were maxed out on credit, pay down their bills, etc. And that led to, we can quantify this from the data, a 40-point increase in credit scores. So if you were a 720 credit score, you came out of the pandemic, or say in 2022 at a 740 credit score. So now going back to the Fed data, we are seeing a pickup in delinquencies. It's not uniform across different credit channels, credit lines, but we are seeing a pickup. In certain credit lines like mortgages, it is a normalization. So one might get taken by delinquencies rise 50%, but they went from like a fractionally small number to like a still fractionally larger number. We're seeing that those are now catching up to the pre-pandemic levels, so there's a normalization. The range in mortgages that are delinquencies is very much concentrated in, it's important to know where, and it's concentrated in the stretched borrowers. And those are the borrowers primarily in the ones if, say, for instance, they got this FICO, as I said, up to 740, they got a loan, they took out a mortgage rate at 6.5 or 7 or even 7.5%, let's say. There was an adage back then which was marry the home and date the mortgage, right? Which was that rates will come down eventually, as they always have. But what's happened is property taxes went up. Insurance is either not available or it's gone up. You didn't get the lows in mortgage rates. And so those borrowers, if they've seen these marginal increases in outlays, which has challenged their debt to income, those are the borrowers that are suddenly going delinquent. The owner operator model at Rithm leads to us having several operating companies, and we have a vertically integrated system from our top four in the country mortgage lender, which is new residential. We have the top three mortgage servicer in the country under new residential, used to be called ShellPoint. We have the nation's, if not one of the tops, very close to the top, lender to home builders, direct lender to home builders. And that's Genesis Capital, which is based in LA and was bought from Goldman Sachs Merchant Bank. They were at about $1 billion when we bought them. They're now running closer to $4 to $5 billion. It's a significant pickup. And then we have a footprint across the country of single family rentals through our Adore platform. So it's all vertically integrated, and I cannot emphasize that somebody like myself is having the visibility to performance of across these different, from home builder projects, sponsors, timelines across the country to 4 million consumers that are serviced within New Res, to the thousands of properties that we have at Adore and renewals from single family renters. We are not seeing any alarming trends, I would say. Year on year, the K-shaped recovery in the consumer has clearly drawn a lot of attention. Some of the subprime issues have really drawn some attention to the weakness of the consumer. In what we are seeing relatively stable trends, I will say, on a forward-looking basis. I'm a little comforted by two things. The stresses on the lower end consumer. One is because of the hit to immigration overall, is a lot of the lower end consumer have high labor participation in areas like healthcare, leisure, and hospitality. And that's where I feel that we're going to have some possible upside to wages. But the lower end consumer is also, and I think the economy is also getting something that I don't feel has been spoken about much broadly in the markets, but it's the almost $30, $35 decline in oil prices. And I think that is going to go ahead and ease up some, at least partially, some of the outlays on some of the households that are at the bottom 25 to 50% of the US population, but it will also provide a lot of boost to manufacturing and industry that relies on oil. So, just better economic, corporate margins, which is how we evaluate where the economy is going, and the ability for those corporations to go ahead and retain workers, hire workers, pay wages, etc. So you got to see all of those other than the government, the corporate balance sheets, household balance sheets, and then of course the government to get a sense of where the economy is moving.
Thank you for that overview. So, as people could see, Rhythm Capital does a lot of things. Fourth largest originator of mortgages, third largest servicer, and second largest residential transitional loan, Genesis Capital. So lending to home builders. So through the servicing platform, Rhythm has a lot of visibility and control and exposure to mortgages, both agency mortgages and non-agency mortgages. And I want to say that that's the exposure as a servicer, different than owning those loans. Although Rhythm does some of that as well. So just looking through the delinquencies of the different servicing of the GSEs, I see from the annual report they're low at 0.3%. That's very low. In non-agency, that's expectedly higher at 2.6%. And then in Ginnie Mae, that's 2.6%. That as well. That's interesting to me because Ginnie Mae is also an agency, but I'm sure that there are reasons for that. Roughly, how are those delinquencies compare to history, and what are you seeing right now in those portfolios? The data that I'm seeing, I actually, it's not even from the quarterly report, it's all the way back from the end of last year, 2024. So I'm sure that the data has changed, but just roughly in those servicing market where you're collecting the mortgage payment every month, how are the health of those markets? And again, I just want to say that just because Rhythm is collecting on special servicing or somewhat delinquent loans that are having credit issues doesn't mean that Rhythm Capital ultimately has the exposure. Just to be clear.
Thank you for making that point. Um, when I look at the book, I would segment it out into prime quality, and prime borrowers are mostly in the Fannie Mae, Freddie Mac books, where they have the credit exposure, or they can be in the non-agency or the private label market as prime jumbo. In those sectors, and I'm looking at tables here that I monitor all the time, we're seeing no change on a year-over-year basis and 60-day delinquencies. That some people look at serious delinquencies in the 90-plus bucket. I'm looking at 60-day delinquencies today versus a year ago. I'm seeing no change on the Fannie Freddie, very modest change upward on the prime jumbo. Then I go into just sticking with the agencies you mentioned, Ginnie Mae, with the FHA and the VA. I'm actually seeing a drop in the Veterans Administration delinquencies, and I'm seeing a rise in the FHA delinquencies. It's modest. The 60-day numbers are up about 8% from 5.4 to 5.9. And I think that these are stock numbers, so the weightings across vintages can vary. I suspect, as I mentioned earlier, a lot of the rise in the delinquencies is concentrated in some of those what I call stretched borrowers and some of the post-pandemic originations with high rates. Now, the Ginnie Mae FHA is the most levered borrower. They have equity of around 3% in the home, so they're arguably they're lower FICO scores, and so they're arguably weaker credits than the prime. And they also tend to be mostly purchase mortgages. It tends to, so that segment definitely has a perhaps higher representation of those borrowers who I said bought after the 2022 hike in interest rates in a higher rate environment. And then I moved to the non-QM or the non-qualified mortgages outside of the mortgages made outside of the agency tight credit boxes. And there we're seeing a modest increase in delinquencies. And then finally, in the unsecured consumer sector, I'm actually seeing a decline in delinquencies of some of uh, some of the credit lines that we monitor there.
So
In
are those
prime auto,
consumer loans and not mortgages? Yeah.
yeah, these are unsecured, so there's no collateral, there's no home behind that. Everything I covered until now was with a mortgage or collateralized. And then the auto sector has gotten a lot of attention, and I do see that subprime auto, we are seeing an increase, and in prime auto, we are seeing a very modest increase. So credit quality really matters. Collateral versus non-collateralized matters, especially when I think about auto versus mortgages. I think it really matters. And then the unsecured consumer, I think, is it stood out to me when I saw these numbers and was reviewing these numbers. The 60-day delinquencies have declined. Now, I will also say that even in certain sectors where delinquencies are rising or delinquencies are present, we are not actually seeing the conversion of that into losses. And this is where the point of collateral of servicing really matters is you can have delinquencies, but if you can go ahead and reinstate the borrowers through modifications, and maybe we'll touch on this when we discuss housing and home prices, but I think one of the big changes that's occurred in the last, since the global financial crisis in the last 15 years, 15 to 17 years. A lot of the rules got codified really over the last 15 years. Once Dodd-Frank came about, the CFPB, the servicing standards got set. And it's been remarkable how much downside protection has been provided to assets that are related to especially mortgages. And it's not just the products I covered. It could be assets like home improvement loans. It could be ranging into home equity products. Because we talk about the wealth effect in stocks, right? But there's also been a commensurate wealth effect in housing from the pandemic fueled almost 20% year on year increases in home prices. So borrowers, there's a national scarcity and shortage of housing. It is the worth of the product has increased significantly. If I look at it versus commensurate markets like rentals versus housing, the value proposition on a buy versus rent for somebody who's still in their home, right? So if I'm going delinquent, like, and I'm an investor loan, like I've still got like the opportunity to rent that house, or if I own my home, I have the opportunity to rent that house, right? Even if I run into some issues. So the worth and the value of that property and that collateral is high. And that goes ahead and prevents the transmission that we saw during the crisis of lots of delinquent loans all going through foreclosure and creating this, really fueling the housing crisis and all the collateral damage that we saw unfold during the great financial crisis.
Thank you, Satish. So, some viewers of this podcast may be thinking of a certain interview when you said the word modifications. I interviewed a very in the weeds bank analyst who talked about the high rate of modifications that banks are doing on their commercial and industrial books. So, in that sense, some viewers may be left by a bad taste in their mouth by modifications. When it comes to mortgages, um, I think that's a really important point because ultimately, what exacerbated the great financial crisis was servicers were far too aggressive in foreclosing, and if they had just modified and slowed things down, probably the crisis would have been a lot less bad. So talk about the rates of modifications that you're seeing, and then also I just want to underscore that point of how when you lend against on collateralized loans, the credit quality increases when the value of the asset increases, and that it's no surprise that it's no secret that we're in a strong housing market. So we'll get into housing prices in a moment, but just tell us more about those modification rates you're seeing for the stretched borrowers.
So did you want, just to clarify, you wanted to talk about modifications on mortgages or
Mortgages.
commercial real estate?
Let's start with mortgages, and then we'll go CRE. Sure, mortgages first.
Yeah. So I think what happened the learning from the financial crisis was, and it was really for those listeners who were able to witness the unfolding of the GFC reforms, and it was the home affordable modification program that was rolled out, and there was a parallel with the home affordable refinancing program. And the idea was of both HARP and HEMP, and the government had rolled this out. This was under the purview of the regulator for Fannie Mae and Freddie Mac, um, the Federal Housing Finance Administration. And that set off in codifying modifications for borrowers who were witnessing problems. And a lot of those modifications were to go ahead and standardize across servicers, because without the rule book, right, it led to the tailspin scenario that you mentioned, right? Every servicer, it led to them doing whatever they could do to enhance recoveries, which often was go ahead and speed the process through into foreclosure to dispose of the property. And it led to, there was no standard way of dealing with borrowers. And since HEMP was implemented and the way those modifications were extended is either go ahead and reduce the coupon to meet a certain debt to income cap so the borrower could sustain, to go ahead and extend the term of the mortgage from a 30-year to a 40-year mortgage. Then developing in the capital markets, the market for a 40-year mortgage, right? Because the standard product is a 30-year mortgage. So that whole codification, development, refinement of that modification has led to a rule book now that pretty much every servicer offers. And I think it extends also not just in the GSC universe, but it's a playbook also for the non-agency universe. And today, I think that is on the residential side, almost like a hard-coded. You can see what the recidivism rates have been, which modifications have been successful, extending trial modifications for seeing the performance over a short period of time, for 3 to 6 months, to then revisit the modification structure, are all waterfalls that are implemented across the mortgage universe. To me, that rule book, and I think the real important piece of it is how well I feel that has been applied in the office sector and commercial real estate. And the fact that in 2023, 2022, obviously rates going up, and whether it was across CRE, but specifically in the office sector, because there was a compounded effect of the return to office, or rather more the dominance of work from home, and the grudging move of employees being willing to return to office. It obviously created a lot of stress in the office sector, but it's clearly 3 years since it's not gone ahead and led to kind of that downward spiral. Have there been drops in home prices? Have there been properties that have sold at, 10, 20, 30 cents on the dollars? Absolutely. But I feel that the special servicers have worked with the borrowers. The cycle I see it went through was, I think the terms in the commercial real estate sector was amend and pretend. It almost seemed like just amend the loan, modify now, and we'll kick the can down the road and pretend like everything's all right until things surface, and then that went to amend and extend, which was the workouts was either going ahead and amenitizing the buildings, is getting some more equity capital into those buildings, as well as they went through modifications, whether that was forbearance plans to modifications, but essentially, I think really borrowing now from the residential sector and what went through post GFC. And I think they've done a remarkable job. And I will say that um, it didn't happen because of any government intervention. This is entirely the private sector. It's entirely the doing of the private sector. And I think it's been remarkable to watch.
And in the commercial real estate world, let's stick with office. How much of this special servicing workout? Okay, we'll you modify a loan. How much of what you just talked about was within the banking sector of banks making loans, or is it everything you're talking about were the loans in the CMBS market, the commercial mortgage-backed security market?
So the CMBS market is obviously where we have the greatest visibility. That's the benefit of securitized market. So it was definitely in the CMBS markets. The bank holdings of commercial real estate, and particularly office, a lot of the regional banks have that exposure. It's a larger share of their books. And I don't have as much visibility into that directly, but I would be surprised if there hasn't been some of that. Now, I will say the office market also is the urban centers versus more suburban. There's a difference. There's a skill segmentation. So I do think that a lot of it is property dependent. It is sponsor dependent. It is location dependent. Is it close to commuting hubs, like we've seen what's happened in Midtown Manhattan,
Mhm.
right? Around Grand Central, around Penn Station. There's a lot of those factors, how old the properties are. Everybody wants to work in a modern, amenitized building. So there's a lot of variability. So I wouldn't necessarily draw a carte blanche and say that every office property across the country in bank books, in CMBS. But I definitely feel that we've definitely turned a corner. And as you also have seen that, um, we've announced our intention to step into the office sector with our intended closing on the acquisition of Paramount Real Estate Group, which is going to go ahead and give us the exposure across about 13.5 million of Class A buildings between Midtown Manhattan and San Francisco. And so this is something that we have high conviction around, but it's also been a select portfolio in cities that we have very strong conviction, either due to the demand dynamics, the scarcity that is developing in office in areas like New York, but also the civic leadership and the knock-on effects of AI in the San Francisco region.
So you are exposed to as a servicer within the commercial mortgage-backed security market, but you're expanding your footprint earlier in September, announcing your intended acquisition of Paramount for cash consideration of $1.6 billion. Tell us more about the philosophy and thinking behind this deal. Would you agree with the characterization that it is contrarian, given how much doom and gloom there has been about the office sector over the past 3 years?
So if I just look at the journal's headlines for the last few weeks, since we announced the Paramount deal, there have been three front page articles on the value of New York City office. I think there were two, specifically on New York City. And just this last week or last few days was on the turn in San Francisco. So I do feel that um, the doom and gloom that you mentioned was at its peak perhaps in 2023.
Yes.
And then 2024, we did see the CMBS market opening out, even for office, right? So there was capital being put to work. We did see several Park Avenue properties that were big in the CMBS sector, and they were worked out and they were resolved. They weren't, there was a risk of ratings downgrades and bondholders taking risks. So I feel that definitely those are early signs, right, of successful outcomes in the sector. So I feel that doom and gloom had passed, and we had been stepping in. We had bought some office interests in various forms in smaller scale. This opportunity presented to us because of the scale and the ability to go ahead and express the view that we've been formulating for a good part of the last 2 years. I've written a piece, I think it was in 2023, it was Life in Office is Not All Bad, right? But it was basically going ahead and seeing some of what I think we've manifested and observed actually happening since. So it was a good time because of the scale. We do believe that there's certain asset classes that you can go ahead and access, and scale is important in those. And so the combination of the opportunity buying these properties at discounts of almost 40% to pre-pandemic levels, 25% to 30% of replacement value, the local considerations, because real estate is all about location, location, location. Those all helped our conviction levels on this.
And how much of the play is you like the assets, high quality assets, real estate values are recovering, office values are recovering, versus the liability of part of the reason there was so much doom and gloom in all of CRE really was because the Federal Reserve caused it, shocked real estate investors with a huge interest rate increase in 2022 and 2023, and now the Federal Reserve is moving the other way, and
Yeah,
the value of being a floating rate borrower is good when interest rates are going down.
definitely helped, but that's not in our control,
Mhm.
right? So a lot of the focus of our owner operator model is also understanding what's in our control, what's not in our control. But absolutely, I think that for the real estate sector is one of the prime beneficiaries of lower Fed funds. It helps with operating leverage. It definitely helps. So the timing of it was, with the Fed cutting and intending to continue to cut, is opportune.
I think you nailed it when you said the peak and doom and gloom of commercial real estate. And like a lot of financial journalists, I produced some of that content was in 2023. I don't think it was an accident. That was the bottom in prices of publicly listed office REITs in particular. That the value of buildings may be different. I don't know. Tell me about the fundamentals that you're starting to see in offices. I'm, multiple years out of date, I'm afraid to say, but in terms of occupancy and vacancy, I believe vacancy is how many people are actually leasing the buildings. Occupancy is how many of them are actually going to work. And then there's, I guess, more granular data on people tracking sign-ins of, oh,
Yeah,
so in the peak of COVID during 2020, there were a lot of companies that were paying their rent, but no one was going into the office. That has
yeah.
now changed. So in terms of vacancy and occupancy, what are you seeing and kind of expecting? I guess you could say both for general office, but in particular the portfolio that you are planning on acquiring.
What I actually am monitoring in New York, apart from those aggregate trends on vacancy, we look at all the sign-in data and return to office. And New York's leading the nation on this, as return to office is now, if not 5 days a week, it seems like at least folks are in between 3 to 4 days. I think the aggregate numbers are somewhere in that range. And we're monitoring that in San Francisco now as well. But to me, what's interesting in New York is the success of some of the conversions of office into residential. There was a great article on Bloomberg along also after the Paramount deal, along with the three journal articles that I mentioned about the Pfizer headquarters on 42nd Street and plans to go ahead and convert that into residential. The Chase building downtown that got converted into residentials in the financial district. So what's that's all adding to is going to be, if you look at the future pipeline, the economy keeps growing, and you see, as long as the labor markets hold up, is going to go ahead and create a scarcity of office. And I can speak firsthand. The Rhythm complex, whether it is us as a holding company to any other operating companies that are here in New York, we see we don't need to go ahead and look at the aggregate metrics. We can speak from firsthand. And just in terms of our expanding footprint as we grow through acquisitions, is the demand for office and the scarcity and the uptrend that we're seeing in the rates, in the lease rates. So we see that firsthand because we need more office space ourselves. I wanted to contrast that to San Francisco. San Francisco is different. It's clearly since 2022, we saw the AI frenzy, and one could argue that the gut response when we were heading into the Paramount deal was I just asked people, like, what do you think? Is AI going to lead to more in office or less in office? And it was a 50-50, or even like more people said less in office, which makes sense, right? Because you're increasing productivity, machines are doing the jobs of humans, you need less humans. And that's how the argument and the logical mind flows through. But where we are in the AI cycle right now, and again, I know these through firsthand stories of through friends and folks who have started AI ventures successfully, they need more office because they're developing applications at such a breakneck speed. They need teams of people to work together and come together. And so they actually need more office. And San Francisco and New York collectively are more attractive and have more graduates from the top 20 schools in the country as magnet cities of desirable places to live. That I think is an important fundamental factor. So those are some forward-looking views. We can go through data and trends and all, but I think the forward-looking views are very important.
So, and that's demand. Supply, of course, matters as well. For example, it's a very tight housing market, but I believe it's not a good time to own a lot of apartments in Austin because everyone built so much that I think rents are going down. So supply matters as well. And
Yes.
supply, because everyone was so doom and gloom, there haven't been a lot of new offices built over the past few years, right?
That's correct. It's been hard to get financing, and absolutely.
And tell us about the Crestline acquisition, another announced but not closed acquisition, an insurance company. Tell us the rationale here.
Crestline has, it expands our foothold across three very distinct verticals. I will say through our acquisitions, they're all very thoughtfully considered. It's not the only acquisitions that we're seeing. We're evaluating them against a broader backdrop of what is on offer out there. And in making sure that our aggregation is one where we see the opportunity to go ahead and have the ability to scale specialization. And Crestline, it's got its main assets are direct lending, its expertise rather. It is in fund liquidity solutions. And their insurance and reinsurance is a more nascent business. It's one ripe, and we have a lot of ideas and plans, for that. The appeal is obviously complementary strategies and then growth opportunities. And it's, again, the driver is you've got significant presence of the insurance markets across the variety of assets that we touch. And the fundamental driver of that is the retiring baby boomers, with all of them turning 65 in the next 5 years, right? And I think I saw headlines of the pace at which many of them are even turning 80, right? So you have an age group between 65 and 80 that is retiring, that needs income, that needs liquidity, that needs cash flow, it needs safety. And that actually is, whether it is insurance companies, whether it is our focus here at Rhythm on asset-based finance products that we are able to source, originate, service in various private fund strategies. That is really the mega trend that is taking place. So we see the opportunity here to go ahead and be able to grow that across various ways.
I hope you're enjoying today's episode. As many of you know, the asset management game is changing. Increasingly, alternatives are eating into both stocks and bonds and becoming staples for all types of portfolios. With over 25 trillion already in alternative investments and 20 trillion more projected in the next few years, clients expect more than surface level knowledge when it comes to alternatives. That's where Kaya NXT comes in. It's a self-paced learning platform designed for financial professionals who need to understand and speak credibly about hedge funds, private equity, private debt, digital assets, real estate, and more. With Kaya, you'll learn directly from the leading allocators and alt managers shaping today's capital flows. So what you learn today, you'll use in your next client conversation. Whether you're an independent advisor or you're trying to get ahead of your peers in a larger organization, Kaya NXT gives you the edge to stay relevant. Visit the link in the description to get 10% off and start mastering alts for your clients today. Be future ready with Kaya. Tell us more about what you're seeing in private credit. Bloomberg famously a year or two ago has called it the golden age. Certainly within the world of alternative investments, overall speaking macro, hedge fund AUM is not growing a lot. Private equity AUM is not growing a lot. The huge growth has been in private credit. Yeah, just tell us more your thoughts here. I want to, whatever is interesting to you.
I feel investors have embraced private credit over the last 8 or 10 years. But today I see that what asset managers are offering investors is, what are some other strategies that expand and diversify with close to comparable return profiles and targets, but are able to go ahead and provide and satisfy some of the other attributes that I mentioned in terms of this aging demographic. Because what happened is, when you had in the last 15 or 17 years of zero interest rates, right, where did your allocations go? They went into taking on more illiquidity, whether it was private equity, whether it was venture capital, right, and adding a lot of illiquidity into your portfolio. So the real thrust I feel today, and private credit, as you're talking about direct lending, right, because you are getting income, you are getting liquidity, but within that liquidity bucket, I think that there's a certain maturation point or a saturation point in exposures that have been built. And now investors are saying, what else can I look at? And so collateralized cash flows or real assets. And I feel that it's not just about private credit, but I'm going to just talk a little bit more about some of the portfolio allocation issues that institutional portfolios have. Like, if you look at treasuries, right, you'd say it's hedges my risk, right? I add treasuries to hedge my risk, whether it's in credit or equities. Well, we went through a period there where, and 2022 proved that the correlations went up. Risk and technically risk-free assets, risk went up. So if I'm an endowment or if I'm a pension fund and I'm looking at a treasury, I'm not even going into direct lending or private credit as you know it, is the discussions are like, how much of a hedge is it going to provide to me going forward, right? And how much liquidity is it going to provide? And clearly, I think with the recent last few days, last week or two, where we've had some turmoil, not turmoil, but some turbulence in the market is a better term. treasuries rallied, and suddenly the store of value came back up. But I feel investors in the longer term horizon are looking at other assets. Liquidity is key, hedging value is key, apart with the aging demographics. And I do feel that that direct lending and other diversified assets like asset-based finance can play a role in that because they do provide income compared to, say, private equity or
Mhm.
venture capital.
And private equity and venture capital has definitely been a little slow to return cash to investors.
Yeah,
Let's put it that way. So interesting. Tell us about asset-backed finance, ABF, within the private credit ecosystem.
yeah.
What are the kind of loans? What is the kind of credit quality? Are these seen as riskier than direct lending, less risky, and how do they differ?
Yeah. So asset-based finance, very simply, I'll give you two sort of reference points for the listeners who know that you need in your life transport, be that rail cars, aviation, be that planes, all the way down to homes, be that mortgages, loans to home builders, uh, inventory financing, anything that is collateralized or as a contractual cash flow. Right. So asset-based finance very broadly touches everything and every aspect of our life. Right. Um, the asset-backed securities market has existed for decades. It's not new. The way the the reason why asset-based finance has emerged, and I would say a year ago it was just defining what it is. Today it's evolved. We're in the second of what I see as a 9 inning process, which will possibly take the next 9 years, as I see it, as people spend a little bit more time into it. It is the demand factor is what's really been driving a lot of products that were in asset-based securities, but the scale of the demand is so large that you actually need to go ahead and have and create an asset-based finance or asset-based lending vehicle or channel. And so just I gave you the example of insurance companies and the annuities, the aging demographics. They are not going to fulfill that demand by participating in a public asset-based security or an asset-backed security. Because the way that that market has been structured is to credit tranche. The
Mhm.
rating agencies come in, you created rated securities based on data models that help you understand the risk profiles, allow the rating agencies to rate the transactions all the way from, say, 90% is AAA, 10% is sub AAA, and then they are higher yielding sub AAA, but you're not going to be able to get enough of the 2, 3, 5% of those subordinated tranches to meet your demand. So, what the asset based lending or the asset based finance market is, let me just take that full 100%, right? You like the risk, you like the scale of that. I can manage the risk and I can go ahead and create an asset based finance vehicle. So, that's really what led to or whether it's mortgage assets, whether it's consumer receivables, such a large part of the US economy is the consumer that no matter which part of asset-based finance you're touching, they all have different betas, so to say, to the consumer, right? Mortgages and consumer are just one example, but as I said, rail car transportation, receivables of varieties of kinds, music royalties, patent litigation, right? I mean, there's so many other products that fall into the spectrum, but at the end of the day, the um, demand for diversifying, for liquid solutions, for collateralized real assets, I feel also is part of the store of value. So until the last 2 days, the surge in gold prices, silver prices, The central banks clearly diversifying their treasury holdings into gold has been a big technical. But I feel generally I put that as a search for store of value. But if you have something that you can point to the value, to the asset, to the real asset, to the collateral that's backing it, then that is the makings of asset-based finance.
So an asset-based finance, is it mostly unitranche or not tranched out like the old school asset-backed securities are?
Yeah, these are not tranched. They're generally loans. There are other flavors where investors or investment managers might buy um, would be securities, rated securities. So there are certain pockets where they could be credit tranched, but generally the more higher rated the asset quality, then you want the loans because you're comfortable with the quality that you don't mind taking it in unrated form. But if it is, you get the yields through the yield play comes in the form of loans.
And how do these yields compare to direct lending? Roughly, what is generally the yield profile, in comparison to direct lending? Direct lending has higher yields than the high yield bond market, higher yields than the investment grade market, and generally, higher yielding things are seen to have more risk. Where on that spectrum of yield and maybe risk is this asset
Yeah,
based finance?
I think they both kind of converge, but from opposite ends. So direct lending, the metric is illiquidity premiums. They've come in, right? And then for asset-based finance, because these are collateralized, you can get leverage. So they're levered premiums, and those levered premiums, just because base rates have been so high.
Mhm.
And that's something that I think is also important is when you think about credit versus equity, right? Is because base rates are high, is it's helping the overall yield dynamic that you can actually offer competing returns, which generally are in the low double digits range, and they've converged. But how
Mhm.
you get to that yield varies.
That makes sense. When I hear asset-based finance, I generally think of a trend, which is a migration of credit risk from the banking system to the non-banking system. I imagine some of these loans, it used to be some banks that would make the loans, but for various risk appetite and maybe capital ratio and regulatory reasons, it's now the non-bank sector making these loans. That also makes me think of the synthetic risk transfer market, which has been quite a large market of banks selling uh, credit risk, in some instances through credit linked notes, to non-bank players. And I know Rhythm Capital has in some way been involved in that market. Could you just generally share your thoughts on that trend, your outlook as investment as a strategist, and maybe Rhythm's participations there in general?
So this is not new to Rhythm. Rhythm, from its origins in 2013, um, 12 years ago, has been essentially filling the void that the banks pull back from all the regulations, right? So, that is a structural trend that's in place. Banks are intimately familiar with a lot of these assets. They have amazing origination, reach, and capabilities. Um, that makes them great partners where entities like Rhythm come in is the ability to go ahead and bring in specialization, right? So a lot of the live, real time, high touch aspects that we bring in through the operational elements to go ahead and guardrail the performance of these assets require highly specialized infrastructure, require highly specialized skills. And I think that is what is better placed with specialized hands that may not be of the scale of the reach that a bank might want. And I think that are the banks participating in this ecosystem? They absolutely are. They are very much, because of their familiarity, is providing financing and working hand in hand in enabling this ecosystem to flourish. So I don't see it as, I see it almost as, and literally I think I have to show it this way. It's working hand in hand with the banks and pairing what the best fit is. On one hand, the specialization of operations, and then on the other hand, it's the ability to finance that. And I see it, as not either or, but a big and.
So generally, the a trend, not the trend, but a trend is banks, uh, some of their credit risk moving off of their balance sheet onto a balance sheet of a non-bank player, and instead banks are then making the loan to that non-bank player. That
Yeah,
is a trend.
yeah,
Hmm. Thank you, Satish. I now want to ask you just about very general macro question about housing prices. I know you in particular
yeah.
wanted to talk about that. The doom and gloom about the residential market, pales in comparison to a office, but certainly there are a lot of naysayers, and I think they really have been proven wrong, because even though interest rates rose so much in 2022, housing prices in aggregate, in the case Schiller, have generally trended higher. So just what's your state of the overall market? How much of it depends on geography? What's strong, what's less strong, and what's your outlook going forward on housing prices?
So it's a paradox. And I think the three factors that you have that are shaping whether it's 4 million run rate on existing home sales, new home sales, home prices flatlining, is the fact that you have a mix of low affordability. That's because of high rates, persistently high, low supply. Studies show about 2 million homes under supply in housing, and that's just because of all the reforms from the financial crisis that led to housing being a smaller share of GDP. And we never really resumed the full share. And then we've got high prices, even though prices have flatlined, but they haven't declined. On touching each of those, on affordability, a new borrower today needs to pay about 40% of their income to afford a home at current mortgage rates, current prices, standard LTV, loan to value requirements. That was as recently as in early 2022 was 30%,
Mm.
right? So it's become more challenging for borrowers. And it's not like there's any relief coming from rentals either, right? Rental rates are also elevated, especially in desirable places. But the gap of buying versus renting has widened. It's much more expensive to buy than to rent. The supply conditions, I look at it from two frameworks. One is the stock, which is we've got a 2 million scarcity of homes across the nation. But secondly, is we are also reaching peak home buying years. The millennials kind of have just crossed. The Gen Z is coming into their peak years, so you've got a supply demand imbalance. But also on a flow basis, when looking at number of listings, right? There's been a lot of headlines around an increase in listings, but this goes back to the points I shared on delinquencies. We're only seeing a normalizing. So the aggregate number of months of supply, which is how many months would it take at the current selling rate to clear the existing inventory, is 4 months. A rule of thumb is 6 months is a balanced market. So we're still undersupplied even on the listings basis. To get to that 6 month mark, we need something like around a few hundred thousand, about 600,000 homes, additional homes to be listed. Now, take a step back from all of that. And I think that the home price scenario is one where we flatlined. And the question is, could we go to negative home prices? Have we seen negative home prices in certain states? Absolutely, a trend. And as we cross that
Decline in home prices. Yeah.
declining home prices, right? Is we saw that in Florida. As soon as we crossed 6 months of supply, we went towards 8. We started to see a softening in home prices. You mentioned Texas also, as we started to approach that, we started to see home prices come down. So we've seen some pockets of regional stress. However, when we take a closer look at that, and as we put places like Colorado, it really makes us reframe, is this a core housing issue which is manifesting in this home price weakness, or is it something else? It's a tax problem, not a
Mhm.
housing problem. And so there have been some headlines recently just about, I think it was again this week in the Journal, or may have been in the Times, but about the insurance premiums, right? And in Florida, especially after the hurricanes, it was impossible to get insurance, or the insurance was very poor coverage. And now we are seeing, some IPOs in the insurance market, and some even talking about lowering insurance premiums. But going back to the stretched borrower, right? If you've got high rates, then you planned on a certain outlay based on insurance, and that goes up 10, 20, 30, 40, 50%. And insurance, as you know, in this country, is all state um, regulated, right? It has led to a lot of that regional stress that we're seeing in housing. The Northeast, the Midwest are undersupplied, more affordable. So we're kind of seeing a mean reversion of trend because everybody rushed to the South and the Southeast, notably during the pandemic. And now the return to office is bringing back. Folks are moving to places like Ohio or, the Northeast.
And you know, would you attribute the surge in prices from, I mean, probably 2011, but really 2020, uh, to organic demand and an undersupply rather than a credit bubble that we saw in the mid 2000s?
Oh, yeah, it was not a credit bubble. I mean, people did take advantage of 3% mortgage rates, but it was driven entirely by the added value or the growth in, again, I kind of look at assets and price cycles from a price value worth dimension. The worth of the asset went up,
Mhm.
right? Because you were working from home, you wanted a bigger home, the kids were being schooled from home. We had hits to socializing and not being able to go out and meet, and social distancing aspects. It also manifested through people wanting more cars. So I feel that it was organic, and it was definitely not a credit bubble. Credit standards didn't ease, and lending standards didn't ease.
So, Satish, the very modest decline from the summer of 2022, really just during 2022, led so many people to become so bearish on housing. But housing is the case Shiller I'm looking at is well up since then. How would you characterize your outlook just on overall U.S. home prices?
I think regional dispersion.
Hmm.
So I do think that when the markets were surging, there was everything. I mean, home values are going up across the board, right? So there was strong correlation. Clearly, some states like Florida led, um, right, and New York didn't. Now we're seeing a little bit of a rotation out there, but I think that aspect of regional dispersion stays on the outlook. I think the forecasters are all across the street. They're
Yeah,
better at forecasting. I'm more a consumer of their forecasts. I've
yeah.
seen the forecasts flatlining. Some even may not the central scenario may not be negative or home price depreciation, but it's certainly something we're putting higher probabilities of. Um, I um, I feel that they're better positioned to go ahead. For us, it's much more about looking at the second order effects of that.
That makes sense. Tell us, as an investment strategist, your outlook on the uh, RTL market or the loans that you make to home builders through Genesis. Um, what is the overall business health you're seeing? I know that the boomer profits of 2021 are not there, but a lot of home builders are still very profitable as you've had very home prices. Admittedly, some chunk of their profits they have had basically to eat the cost of higher mortgage costs by basically giving their consumers some I forget what it's called. You tell me, but you know what I'm talking about. And yeah, just your view on the overall credit quality of their loans. Have that changed?
It's a fabulous business that really is tethered and structured around a bank credit lending platform. So the DNA of that platform our head at Genesis and his counterparts all come from being working long tenures at banks, working with regulators. So it takes that DNA to go ahead and deliver into what we see is the track record is one where we're seeing great credit underwriting. The philosophy is of underwriting successful sponsors who have got a track record in project execution and completion, profitable track record. It is about having boots on the ground where you have the construction expertise to monitor the credit and the progress of the projects, and you control your disbursements based on success factors. It is having recourse to the project as well as to the sponsor. And that results in a portfolio that has low delinquencies. And actually, in many ways, when I look at the performance, I have to always take a double take because you actually are turning positive losses. You're not getting losses which are naturally negative. And that's just because of some of the make whole aspects of some of
Oh,
the penalties and the make whole if a sponsor has any disruption in the payments. So, or it could be other workouts, but the resolutions are leading to actually recovering more. But it takes that trifecta of factors, which is the DNA and the culture. In real estate, a lot of the focus generally tends to be on underwriting the project or the real estate, but underwriting the sponsor is critical. And then having the boots on the ground.
that makes sense. Satish, I do want to ask you another question about Rhythm Capital. So, Rhythm Capital legally is a mortgage real estate investment trust. A lot of mortgage real estate investment trusts, kind of the business model is buying a bunch of mortgage-backed securities, whole mortgage loans, non-agency, and borrowing in the short-term market. So you kind of borrowing short and buying these assets, harvesting a spread, and when things work out, that could be quite a profitable business model. Of course, Rhythm Capital does that as well as the servicing. But as listeners here have heard over the course of our interview, Rhythm Capital does 7, 8, 9, 10 plus different things and is really focusing on diversification. Can you just share the philosophy of the firm of focusing on becoming a niche specialist alternative asset manager as well as a mortgage real estate investment trust versus the kind of vanilla mortgage REIT model of just basically buying as many mortgage-backed securities as you can and harvesting that spread for investors?
You're right. I would say that we are more of a hybrid REIT,
Mhm.
right? Given our exposure into credit but if you see where our skills are, right? We really, and I've spoken about the specialization of skills, our strong footprint in capital markets. We have securitized and have issued over our track record about $60 billion of securities. We focus as much on our assets, but we also focus as much on our liabilities, right? I would say it's actually the opposite. We focus more perhaps on our liabilities to support our assets. We originate, service, and our assets through our owner operator model. It lends to and a range of skills that open up the doors to being a diversified alternative asset manager. and that's been the vision. And the philosophy is that if what we're doing is fitting where the market is, and as I said, asset-based finance is where really, if we have the institutional sponsorship on our public securities, we have the confidence that we can go ahead and build the institutional sponsorship on the private side as well, right? And that has timed very well with I think was actually a little ahead of the ABF market, the insurance demand for ABF products coming through. So the decades of experience housed here that lend itself to going ahead and securitizing these assets, valuing these assets, managing these assets, we feel is well suited in the alternatives space. And so the value proposition comes from saying the market puts an X multiple on the asset managers, the market puts a far lower multiple on a REIT. And if you're already doing the work, then let's go ahead and expand our footprint, get the verticals of assets that are complementary, that help us scale the specialization, right? And to expand our owner operator model to grow our alternatives asset business. So the market essentially will arrive at that as we go ahead and deliver into that vision. And the
Thank you.
market, I mean, in terms of valuations.
Tell us more about, you said you like to focus as much, maybe even more on the liability profile. I presume you're talking about your borrowings. Tell us about that, as well as sort of the asset liability match you try and see. Banks, they borrow in the duration of their deposits can be very long, it can be very short in a bank run, so that's definitely a risk in that business model. How do you try and think about that, the match between the assets and the liabilities?
It's very objective driven. It is, us being veterans in the space, decades of experience, asset liability mismatches pretty much are where all the problems have arisen from in the crisis over the last decades. Whether it was the regional bank crisis in 2023, whether it was the Fannie Mae Freddie Mac platforms during the GFC and going prior to that. At least those are the most recent ones that many of your listeners are familiar with. It goes back to the 80s when we had the thrift crisis, right? They also had long mortgages and funding rates went up, and essentially they had like an upside down or negative leverage or higher
Mhm.
funding for the asset deals. So going back to the 80s, out of which a lot of the experience here has grown through a lot of the experience of resolution and workable solutions, and learning from that is our DNA. So we put a lot of focus to make sure that we can pair the liabilities to basically allow us to deliver on the return targets of the assets through the holding period that we're targeting. That the liabilities are, if there are periods of market volatility, that the conditions are such that we can still go ahead and sustain that volatility, right? And if there's any performance issues, that we can go ahead and work through those performance issues. And so that is part of our capital markets expertise that's developed, and we've been innovators in that. We look at those funding opportunities, whether it's through the public markets, through the private bilateral negotiations. The secret and the source is always down to those terms and negotiating those terms, understanding what it is that creates the right match so that you're not going ahead and facing any of these asset liability mismatches. And that helps us to bring the security that we can go ahead and bring all the elements together to deliver on targeted returns and therefore guardrail those returns.
And do you think that the total freeze up in liquidity of March 2020, well over 5 years ago, really put that in focus and maybe crystallized to diversify from the mortgage REIT model? Because I know you joined Rhythm after this, but there was a dry up in liquidity, maybe not so much in the borrowing, but just because it only lasted for a few days, but the it was a secured repurchase market, I believe, and the assets declined in value. That's there was kind of a run on liquidity, and many mortgage REITs delevered, and Rhythm, as you know, was not exempt from that. Do you think that that is part of the philosophy of Rhythm, to diversify into to become this niche asset manager?
I think it's an evolution. I wouldn't say that it was, I think every crisis, every market episode, there's learning from it. There's, an evolution from it. But yes, it's all accretive to me. I look at all of these and, I'm at heart a historian and like to understand the makings of um, whether it's financial bubbles or whether it be even broader and beyond that, and the makings of empires and the destruction of empires and the decisions that are made. But to me, it is, I never feel that one episode is a recurrence of mistakes that I think are often informative. It is a learning of understanding isolated instances but common signals to distill out and what I think is our key focus, and especially mine in being the investment strategist here, separating the signal from noise.
Well, I think we've done it exactly that. Satish, thank you so much for joining Monetary Matters. I've wanted to do an interview on Rhythm Capital. It is such an interesting platform. It is so diversified into credit and shelter, and really, I think a lot of the financial nerds who follow my podcast will be very glad I got a chance to do this. Satish will attach in the link to the description your LinkedIn profile, your post, as well as several of the articles discussed. Thank you, everyone, for listening. A reminder to subscribe to Monetary Matters on Apple Podcasts and Spotify. Leave a rating and review. It really helps the show. Until next time. Thank you, everyone, for listening. Remember to check out Kaya NXT to level up your knowledge of alternatives today. Visit the link in the description to get a 10% discount and learn about what's next for your clients.